Hello and welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Wednesday, July 15th, 2020. Hope you got your taxes done. I am pre-recording this Trading Places Live for Thursday, July 16th. Futures currently appear to be slightly higher for Thursday after another strong session on Wednesday. Looking at the futures, I think still it's a little bit more skewed bullishly towards the Dow and the S&P than it is toward the NASDAQ. And that's really what we've been dealing with for the past few days. We'll talk about that a little bit in just a minute. We do have the agenda. I want to go over that with you first. So we'll start off with that daily market recap. Then we'll jump into the 10-year Treasury yield, look at some economic reports due out on Thursday morning. In talking technically, I want to go through the Dow because the Dow is something I really don't cover too often. Mostly because I follow more of the growth stocks on the NASDAQ. But the Dow's been outperforming of late, so I think it's a good time maybe to take a look at that index. I'm going to go into ChartLists and Industries. I want to show you a little bit about how I use the chart lists and just focus in on a few industries that are breaking out or have just broken out. Going to do a little seasonality for you, getting ready to head into one of the worst periods of the year historically, so I got some numbers you might like to hear. Earnings spotlight, and then we'll wrap up the show with the 3 you must see. First, before we get into all that, I do want to just take you over to earningsbeats.com. You can see here, we do have a free Earnings Beats Digest newsletter. You can sign up, no credit card required. Just simply type in your name, email address, hit the subscribe button, and we'll make sure that we get that newsletter out to you Monday, Wednesday, and Friday mornings. Usually it's about relative strength, earnings. It's a very educational type newsletter, but also some trading opportunities as well. I think you'll really enjoy it. If you haven't already signed up, go to earningsbeats.com, type in your name, email address, and hit the subscribe button. If you want to try our service, you can join using this Join Today button. That'll walk you through the process. It's $7 for 30 days, but the $7 will get refunded. So you literally can join us for 30 days at no cost and check it all out. All right, let's move on to the daily market recap today. We did see a pretty good day. Dow Jones was up 227 points. The S&P 500 up 29. The NASDAQ actually finished up 62 on a percentage basis. It did lag the other two indices, but still not a bad day. Mid caps up 3%. Small caps up 3.7% almost. So definitely outperformance there. And I really like these candles. I think after pulling back and kind of sideways consolidating here, maybe in a little bit of a triangle, it looks to me like both broke out. So I'm expecting some more strength ahead for mid caps and small caps. The leaderboard on Wednesday, very much the same as it was on Tuesday. We saw industrials up 2.5%, energy 2.2%. These two pretty much just flipped. On Tuesday, we had energy leading and industrials were second. Then we had financials up almost 2%, materials 1.7%, and then one of the aggressive groups, discretionary, up almost 2%. Discretionary trying to make a breakout here as well. All of these sectors, except maybe energy, and energy starting to strengthen again, but all of our sectors really are still lined up rather bullishly with price action above the 20-day moving average, which is above the 50-day moving average on most of the sectors. And that's what you want to see. The major indices, same way. So anyone still looking for that big pullback to go back and test that March low, I'm not sure. Not only are you not going to see it in the near term, I don't think you're ever going to see that again. I think we are in a secular bull market. I think we're going to leave that low in the dust, just like we did back in 1987 with that low in the crash. We never went back and tested it. And I think for a while, a lot of folks probably expecting that we would go back down there. We never did. I don't think we're going to go back down to that 2,200 again, that level on the S&P 500. The 10-year Treasury yield. First of all, we do have some economic reports coming out tomorrow. It's going to be an interesting morning. Initial jobless claims coming out. The expectation there is for 1.29 million jobless claims. Last week was 1.31 million. So we're looking for a little bit of improvement. July Philadelphia Fed survey, looking for 20. Last month in June, it was 27.5. So a little bit of a pullback there, not quite as strong. I don't know. Be interested to see whether or not it really does pull back. I'd be a little surprised, to be honest. June retail sales, Remember May's number, 17.7%, the biggest increase in history. Well, we're looking still for a pretty healthy 5.2% rise in June retail sales. And if we strip out the autos, we're looking for still a 5% rise in June retail sales versus 12.4% in May. All of those reports come out at 8:30 in the morning. Then at 10 a.m., so right after the market opens, May business inventories, we're looking for a decrease there of 2.3%. April's decrease is 1.3%. So it looks like business inventory is expected to come down some more. And then July housing market index. This will be a big number because housing stocks just broke out. The Dow Jones U.S. Home Construction Index made a new high, clearing some sideways consolidation. And the July housing market index coming out at 10 a.m. tomorrow, expectations are that we will see 60, and the number was 58 in June. I actually believe we might see even more than that. I think we could be up more than 60. We'll see. All right. As far as the 10-year Treasury yield goes, looking at this chart, I wanted to just point out a couple things real quick. When we saw the last really big rise in the 10-year Treasury yield, from it really off of the mid-May low through the June 7th, actually that would be June 5th or June 8th high right in here, that created, when the yield's rising, it's giving us an indication from the bond market that economic activity is going to pick up. So you get a lot of interest in economically sensitive stocks. You also get a lot of interest in value stocks versus growth. And that's what this panel right here is. It's the IWD versus the IWF. So this is the Russell value versus the Russell growth. And so we've been coming down. But when we do get these little pops in the 10-year Treasury yield, that's when we tend to coincide with value stocks taking the lead. Now, if we look back to the low that we saw back on Friday, this isn't exactly what I'd call an uptrend at this point, a little bit more just choppiness more than anything. But if we can get through that 20-day, I think that this recent surge here in value stocks versus growth stocks could continue for the near term. I'm a growth stock fan, but growth stocks massively outperformed from June 8th through second week or into the second week of July. And so now we're starting to see just a little bit of rotation at this point back toward those value stocks. And down here at the bottom, this gives you a little bit better indication of the correlation. So this is the correlation between the direction of the 10-year Treasury yield and the direction of value stocks versus growth stocks. And as you can see over the last 6 months, mostly we're in positive correlation territory, above zero. But it's not perfect correlation. You can see back in May, we did go the other way and went negative for a bit. But we tend to spend a lot of time up at or near plus 0.75. So that's pretty strong correlation. So therefore, if we do see the 10-year Treasury yield make this break above the 20-day, I would continue to focus on those value stocks. And that has not been where the money's been going. But I think there's a couple reasons why we could see it going there now. One is because of that 10-year Treasury yield on the breakout. The other is because of options expiration on Friday. Many of these value stocks have not participated, so they don't have a lot of in-the-money calls. They, I think, are more free to move higher. Many of the growth stocks, however, if they're heavily traded in options, you've got to be careful because many of these stocks have had huge runs over the past few weeks. And as a result, there's a ton of in-the-money call, net in-the-money call interest or call premium. So just be careful with those growth stocks here over the next few days. Excuse me. All right, let's keep moving. Talking technically, I wanted to just talk a little bit about the Dow Jones. Talked about it at the top of the show. Back in mid-May, when the value stocks started going, that was also the time that the Dow started going. One thing to keep in mind, when we went from negative PPO on the hourly chart through the zero line and went positive, we also broke this downtrend, this little channel that we had going for a couple of weeks. And once we broke out and above that and took out this previous high, that's what led to 3 weeks of outperformance to the upside on the Dow. Now, since then, we've seen the NASDAQ keep going higher and higher, but see how the Dow has really struggled? I actually think off of this double bottom right here, we've come back up and we just cleared this high, which was about 26.6, 26, 6.25, something like that. We just cleared that at the close on Tuesday and then in Wednesday's trading. So I think this could start another move to the upside. I think initially we're going to probably make a run for about 27,550. And then the question becomes, can we get through that? And we'll have to wait and see. I don't know if we make it through on the first attempt or not. All right. Let's keep moving. Actually, I want to take you through. This was the hourly. I want to show you the daily chart as well and the weekly. So on the daily chart on the Dow, you see how after we gap down this sideways action, you know, we got the double bottom. I talked about the highs right around that 26, 26,550, something like that. But it looks to me like we've now cleared that. And I think we're going to run. I mean, we're holding on the 20-day moving average, bouncing off of it. PPO starting to turn up from the center line. I think this is where a lot of times you start to see pretty good rallies. I mean, if you look here, when we turned down and we came back up through the 20, look where we were coming up from, that center line. And that's where we started this big move. I think we're going to run up, test this 27.5, 27.550 area. And let's see if we can get through it. If we do, then I think we really look good. I was looking at the weekly chart and check this out. The weekly PPO just turned positive. I can tell you this. If you go back and look at those really bad bear markets, 2000 to 2002, 2007 to 2009, the weekly PPO never went positive. Weekly PPOs don't go positive in bear markets, not in secular bear markets. We are in a secular bull market. We had a cyclical bear market here. We had a cyclical bear market in the fourth quarter of 2018. That's not unusual to have cyclical or short-term bear markets within a secular or long-term bull market. And that's what we have now, in my opinion. I think we're going to break out eventually above this 27.5, go up and challenge this earlier high, and eventually we're going to break out. I see all-time highs coming. We've already done it on the NASDAQ and NASDAQ 100. I think the S&P and the Dow are coming. All right, let's move on. Chart lists and industries. So the first thing I wanted to do, this is really important because what I've been talking about with members and on my shows and blogs and everything is that there's really been this bifurcated market where many stocks back in February and March, well, all stocks were being sold off at the open back in February and March. We were getting gap downs, but at the opening bell, there was this divergence where strong companies were being bought after gapping down. Weak companies continued to be sold after gapping down. And out of that, I developed my strong accumulation distribution chart list, or my strong AD chart list. And then also I have a weak AD chart list, a weak accumulation distribution chart list. So for instance, on Alcoa, you can see as we went down February, you can see that the accumulation distribution went down with it. On Apple, as we went down the first time, we went lower, but when we went down and put in another low, the AD line never put in a new low. So these were referred to as a strong AD, and then the ones that kept moving lower were referred to as the weak AD, because this was signs of more distribution. Even as Alcoa was trying to rally, you can see that the AD line was going down. Now, why is this important? Well, the market has been going through periods. It's been rotating. It's been rotating mostly towards growth or the strong AD stocks. But occasionally we go into periods where we rotate for a short period of time back into those weak AD charts. So one of the things we do at StockCharts here, when you pull up a chart list like this, my strong AD chart list, I'm going to view all, and I'm just going to do a summary. And this shows the daily change on all the stocks in this particular chart list. Now, if we go over to the weak AD and do the same thing, we can see where, which stocks have been performing best in this group. Now, when you look at this, first of all, just look at how many stocks on this weak AD chart list. Look at how many stocks are gained over 10% today. The S&P only gained 0.91%. But look at how many of these stocks gained. I'm going to take you up to the top again. Look at how many of these stocks went up more than 10%. Look at how many went up over 5%. I'm going all the way down. I mean, just a ton of stocks on this list up over 5%. How about over 3%? Those are three thresholds I use. And then how about 0.91? That's the S&P 500, right? All but about maybe 10, 12 stocks, all but about 10 or 12 stocks on this weak AD list outperform the S&P 500. And I keep this matrix. I keep track of how many stocks outperform. On the weak AD chart list, 95.5% of the stocks on this chart list today outperform the S&P 500. When you can see money rotating to a group and you know that your chart list is made up of all the stocks within that group, it makes trading a whole lot easier. And I've been telling members for the last 2 or 3 days now that this is what's been taking place. We're seeing this rotation, and I actually expect it to continue here until it doesn't. So the opportunities to trade and make money on the long side are much better on this weak AD list. Now, when I go over to the strong AD list, again, there's still a lot of good stocks on here. Only one over 10%. I mean, again, you go back and you look at the weak AD list, there were a ton of them over 10%, several over 20%. You still got a bunch over 5% and still a bunch over 3%. But when I come all the way down to 0.91, which is right here, below, there's a lot more that didn't keep pace. Not that it was a horrible day, but you see how many more stocks on this strong AD list that were underperforming? Only maybe 10 or 12 on the other list. So 95% of the weak AD chart list outperformed on Wednesday. Only 55% of the strong AD chart list outperformed. Now, most of the time since March, we've been looking at the opposite. In fact, most of the time, the weak AD list has been underperforming badly, and the strong has been outperforming solidly. But we're in this rotation period right now. You have to be aware of it. Now, if you're an Earnings Beats member and you're also at least an extra member at StockCharts, we'll send you our chart list. You can have these chart lists. You can download it right into your account, and it'll take you like 10 seconds per chart list. And we have probably 8 or 9 chart lists now on our website that you can download. But these provide some great opportunities for trading. So I wanted to just show you some industry groups that are doing really well. So I'm going to start off with the building materials and fixtures. Now, here was a breakout above that June 8th high. So remember, June 8th, this group did very well when money was rotating into the value stocks. Well, look what's happening again. We're coming right off that 20-day moving average and just breaking out. This is a group that does well when value stocks are outperforming. As long as that continues, this is a good group to take a look at. Now, building materials and fixtures. What can you do with that? Well, if you go to the weak AD chart list and you type in building materials, you'll come up with these 3 stocks. And if you sort it on Scooter, you can see OSB is got a Scooter of 90. So this stock's doing pretty well. It's a small cap stock. Let's take a look at the chart. Yeah, I mean, it's been a great performer. It's been a great performer really since back in March. And look at the AD line. This one actually is broken out. So you can start off by looking at the major index or an industry group, and then you can go into the chart list looking for opportunities within that space. So let's go back now. And the other thing I want to do is, so we get rid of this, you can change these columns and you can show sector and industry group. So that's why when I started typing building, you can see it quickly start sorting. Anything with build in it is going to come up. Now you might have some other things, maybe in the name might say build, which will come up. So you got to sometimes just keep typing the industry group. But that's one group. Let's see, what else do we want to look at? How about industrial suppliers? Now, industrial suppliers have been very strong. Look at this beautiful ascending triangle right here. Equal highs, rising lows. I mean, this is a really bullish looking pattern. So what can you do with this? Well, maybe you go in here and let's pull up the columns. And let's look at the industrial. Not seeing that. Hold on a second. Let's go back over here. Yeah, industrial suppliers. Okay, so I don't have any in this particular group, right? So let's try the week AD list, see if there's any in there. Nope, not seeing any in here either. All right, well, I've got multiple chart lists. We could look at different chart lists, but let's just keep moving. I want to come up back to this and take a look at another chart or another industry group. How about, I mentioned home builders, how about the DJUSHB? This actually just broke above these prior highs. So we're just getting a breakout with home construction. So let's try another group. Let's go in here and let's type in home construction. All right, now you've got a bunch of stocks here. CCS is one that I like a lot. I mean, watch if it can get through 34, but this is a stock that's been showing a lot of strength, especially on a relative basis lately. Look at it relative to its home building peers. Look at it relative to the S&P 500, and there's home builders making the breakout. So we're seeing some pretty good action in this area, and that's one way, again, to take a look and find some candidates. Now, I don't know if we had any home construction in the strong AD because this was a weak group back. Nope, not going to find any here because that group was not doing well back in March. So it makes sense that it would not be in the strong AD. But anyway, that I just wanted to kind of give you a sense of how you can go from using industry groups and finding strength there and going right into these chart lists that we've created. We've done all the research, provided them to our members. And then when you see something you're interested in, you simply just come in and type it in this search box. And you can uncover some really strong candidates. All right, I want to move into seasonality for a minute. And I want to talk about the S&P 500 because at the close this Friday, that's July 17th, we began one of the most bearish weeks of the year. July 17th to the 23rd on the S&P 500 has a minus 21% annualized return over the last 70 years. That's next week. So we've had a big buildup into earnings. Lots of folks, excited about earnings, many of these growth companies. Is it going to be a sell on the news? I don't know. But just be aware that history says that next week can be a very difficult week. Furthermore, from a seasonal standpoint, the S&P 500's worst period of the year, I know a lot of people say go away in May. I say do not do that. Stick around until July 17th. If you're going to go away July 17th to September 26th, because over the last 70 years, there's been an annualized return over that period of minus 2%. And that's pretty significant because the S&P normally goes up 9% a year. So if every period was, basically equal, you would have annualized returns of 9%. Instead, we have an annualized return of minus 2%. So there's, and we start talking about 3,500 trading days, which is how many days are covered from July 17th to September 26th, dating back to 1950. So that's a lot of days to go back and check out. And that's the equivalent of about 13 or 14 years, the same amount of time we were in a secular bear market from 2000 to 2013. That's what this period represents going back to 1950, last 70 years. So it's worthwhile paying attention to. Now, during this current bull market, since the low off back in 2009, we've gone down 5 times in this summertime period, and we've gone up 6. So I'm not saying we're going to, we don't go down every year, but we have had in 2011, we had a drop of 11.64% during this period. In 2015, we had a drop of 9.18% during this period. The 2 best years were 2010 and 2012, where we gained 7.87% and 5.11% respectively. So anyway, just wanted to let you know that seasonality is important. It's at least, you want to be aware of it. I'm not saying you want to short the market because we're going into a bearish period. I still am very bullish the market, but I'm also aware of this period, and I think you need to be as well. All right, earnings. Alcoa came out after the bell tonight. They did beat. They came in with a loss of 2 cents. The market was expecting a loss of 6 cents. Market, or the stock, you can see needing to get through about 13 and 13 and a quarter. And in after hours, the stock, I had it up earlier, but I must have taken it back down. Well, I can probably give you the after hours here in 1 second. And the other company that reported after hours will pull up in 1 second as well. All right, here's I'm getting Alco up on my other computer. It's up. It's 1350. So it is all the way up here to about 1350. Looks like it's breaking out on the will break out on the open tomorrow, assuming that it doesn't have a big reversal. But it is up 6.46% after hours. All right, the other earnings company is Sleep Number. And Sleep Number, if we just look at the chart down here, you can see has been going straight up. A lot of expectations. They did actually beat. They came in with a 45-cent loss versus a 60-cent loss, which was good, but the stock was down like 3% after hours. So we'll have to wait and see. I think it's a buy on, or it's a, buy on rumor, sell on news. If it goes back down into the 47, 47 and a half, 48 area, I would be very tempted to pull the trigger. I like the stock's been going up. Good report. We'll see whether or not we have an opportunity maybe closer to that 20-day moving average. All right, let's move on to the 3 you must see. I'm going to wrap it up with the 3 you must see. And the first stock that I have here, let's go ahead and pull up ENSG. This is Ensign Group. If we pull it up on a relative basis, this is a stock in the healthcare providers group. This is a stock that ran up from mid-May through June 8th, struggled after that, and now here we come back up, making a very nice breakout above these prior highs. This is a stock, saw the volume increase. I wouldn't be surprised to see a run at maybe 48. So ENSG, one of those weak pandemic stocks and that's the group that's leading right now, last few days. So you got to at least know that. You have to realize that there's different groups that have been leading back and forth. For the most part, this group that ENSG is part of has been underperforming, but we are seeing outperformance here. Next up, Expedia. Travel and tourism starting to come back a little bit. I mean, you can see that travel and tourism has been rising here the last couple of weeks, starting to make a run for that June 8th high. Expedia cleared this, we had this sideways consolidation. We cleared the top on the close today. So I think this one's got a shot to maybe make a run at about 96, 97. And then last one I wanted to show you is HSIC. And when you look at HSIC, this is another one that was downtrending for a while, making this breakout, which is awesome. But more importantly, look at this false breakout or breakdown to the downside with that hammer. Anytime I see that, a double bottom and then a false breakdown below it, and we rally back up, that's usually a good sign. Look what it did here after that. Nice move up for 4 days in a row. Anyway, that's it for today. I want to wish everybody happy trading tomorrow. Take care, and I'll see you next week.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.